Confused about capital gains on sale of your home? Hi everyone, this is Simmi Kher, your Sammamish based realtor, and today we are diving into something crucial for home sellers, capital gains tax. Full disclosure, I'm not a tax professional, but I want you to be aware of this often overlooked aspect of selling your home. So grab a notepad, let's get started. And remember, always consult a CPA for your professional and personalized advice. I'm here as a real estate guide, not as a tax expert. So let's dive in. What are capital gains? Capital gains tax is what you pay on the profit from selling your property. Sounds simple, right? Let's look at an example. You bought a home for $400,000, sold it for $600,000. Your capital gain is $200,000. But here where it gets interesting. Capital Gains Exemption 1997 Act says the Taxpayer Relief Act of 1997 changed the game. Before you had to buy a more expensive home to avoid capital gains. And now there's an exemption. Singles can exclude up to $250,000 and married couples get an exemption of up to $500,000. Here's an example. You sell your home making a gain of $300,000. If you are married, you pay zero capital gain tax on that. Isn't that amazing? Qualifying for the exemption, it's not an automatic exemption. There are rules. For instance, you must have lived in the home for at least 2 out of the last 5 years. Let's break down the scenarios with some examples to make sure you've got this. Avoiding capital gains with 1031 exchange, rental property versus primary home. A 1031 exchange is a fantastic way to defer capital gain taxes, but it works differently for rental properties and primary homes. Let's explore both scenarios. Rental property. Meet Sarah, an investor who owns a rental property. She sells her rental property, making a $200,000 gain. Instead of paying capital gain taxes, she reinvests in another rental property within the specified time frame. Result? Sarah defers her capital gain taxes, saving a considerable sum. Primary home. Now consider James, who's selling his primary residence. He sells his homes and makes a $400,000 gain. As a married man, James can exclude up to $500,000 from capital gains, thanks to the 1997 Act. However, a 1031 exchange isn't applicable to James because that was his primary residence. So remember, the 1031 exchange is a fantastic tool for rental properties, while primary homes have their own set of exemptions and rules. Always consult a CPA to explore best options for your specific situation. Let's discuss some of the frequently asked questions on capital gains. The first question, what is capital gains tax? It's a tax on the profit from selling a property like your home or an investment property. It's calculated on the selling price minus the purchase price and minus the costs. Question 2. How does the $250,000 plus $500,000 exemption work? If you are single, you can exclude up to $250,000 of profit from capital gains tax. If you're married, then you have an exemption for $500,000 provided you've lived in that home for 2 years out of the last 5 years. Question, can I use a 1031 exchange on my primary residence? No. The 1031 exchange applies to investment or business properties only. It allows you to defer capital gains taxes by reinvesting in a similar property. Question, How has the Taxpayer Relief Act of 1997 changed things? Before 1997, you had to buy a more expensive home to avoid capital gains. Now you have the exemption mentioned earlier, making it easier to avoid or minimize your capital gains tax. Question: what if I had a rental property and a primary home? Different rules apply. You might use the 1031 exchange for a rental property and the 250,000, 500,000 exemption for your primary home. If I do upgrades and renovations to the home, can I deduct that from capital gains? Absolutely yes. Capital improvements or renovations that add value to your home can reduce your capital gains. These are not mere repairs, but substantial improvements like adding a room, renovating a kitchen, or installing a new roof. Keep in mind, though these costs must be carefully documented, it's advisable to consult with a CPA to ensure you are meeting your legal requirements. Here's an example. You bought a home for $600,000. You added a new room costing $50,000 and sold the house for $800,000. Your capital gain would be $800,000 minus $600,000 minus $50,000. But by understanding and utilizing this aspect, you can potentially save a significant amount on capital gains. Question: how can I find more about my specific situation? I am here to assist you with real estate needs, but at tax-related questions, consult a certified public accountant or a CPA. They provide you tailored advice based on your individual circumstances. So there you have it, capital gains demystified. If you found value in this video, hit the like, subscribe, and ring the notification bell. Selling in Sammamish? I am your go-to realtor. Here's to make you savvy decisions. Share this video to spread the knowledge, and until next time, happy selling.